Welcome to Echo 315, Study Session 3, Sources and Uses of Finance. Introduction. There are a number of ways of raising finance for a business. The type of finance chosen depends on the nature of the business. In this study session, we will examine the different sources of finance for new and existing businesses. Learning outcomes. When you have studied this session, you should be able to 1. Discuss factors to be considered when sourcing for finance. 2. Explain sources of finance to a new business. 3. Highlight the two ways of financing. 4. Discuss the various ways of financing capital assets. 5. Explain the various forms of development financial institutions in Nigeria. Factors considered when sourcing for finance. New businesses need finance to cover both capital for long-term investment and working capital for day-to-day expenses before sales generate enough cash to make the operation self-sufficient. Existing businesses can also finance their businesses through reinvesting a proportion of their profit, known as retained earnings, in the business. Although poor management is often cited as the reason behind business failure, inappropriate, inadequate, or ill-timed financing are also strong contributors to such failures. Whether you are starting a business or expanding one, it is essential to get the right type of finance and avoid common mistakes like securing the wrong type of financing, miscalculating the amount required, or underestimating the cost of borrowing money. The starting point for financing any business is to ensure that you have a well-prepared business plan that demonstrates that there is a viable proposition and that you and any colleagues have the experience, commitment, and determination to succeed. In preparing your business plan, you may require the following: sufficient market research to demonstrate that there really is a market for your product or service. Detailed financial forecasts that accurately reflect the results of your market research and the amount of finance that you need, both for capital expenditure and for working capital. The factors that you will consider when sourcing for finance include the following: 1. Do you really need more capital, or can you manage existing resources more effectively? 2. How would you define your needs? Do you need money to start, or to acquire an asset, or to improve cash flow as a cushion against risk, or to fund expansion? 3. How urgent are your needs? You can obtain the best terms when you anticipate your needs rather than looking for money under pressure. 4. How would you assess your risk, gearing, and interest cover? How would they affect cost of capital of each available financing alternative? 5. What is the state of your industry? Depressed, stable, or growth conditions require different approaches to money needs and sources. Businesses that prosper while others are in decline will often receive better funding terms. 6. Is your business seasonal or cyclical? Seasonal needs for financing are generally short-term. Loans advanced for cyclical industries, such as construction, are designed to support a business through depressed periods. 7. How strong is your management team? Management team is the most important element assessed by money sources. 8. Perhaps most importantly, How does your need for financing match with your business plan? It is important for you to have a business plan because all capital sources will want to see the business plan for the startup and or growth of the business. Sources of finance for business. Large organizations are able to use a wider variety of finance sources than are available to smaller businesses. Savings are an obvious way of putting money into a business. A small business can also borrow money from families and friends. In contrast, companies raise finance by issuing shares. Large companies often have thousands of different shareholders. The sources of finance for new business progresses from own savings, family and friends, to issue of shares as the business grows. For new businesses, the most likely source of finance will be savings, together with informal loans from friends and family. Supplier credit, factoring, invoice discounting, loans from non-bank financial institutions, and bank loans. A small business can also attract extra finance by taking on a partner or by selling shares. Types of financing. Broadly, there are two types of financing: equity and debt financing. When looking for money, you must consider your company's debt to equity ratio. That is, the relation between amount you have borrowed and the amount you have invested in your business. The more money owners have invested in their business, the easier it is to attract financing. If your firm has a high ratio of equity to debt, you should probably seek debt financing. However, if your company has a very high proportion of debt to equity, experts advise that you should increase your ownership capital for additional funds. That way, you won't be over leveraged to the point of jeopardizing your company's survival. Equity finance. Equity or shareholders' capital is the money introduced into a business by the owners. If it is a company, then the equity is introduced in exchange for shares. Investors expect a share of the business profit, either as drawings or as dividend. The person starting the business would normally introduce equity capital, but it can also be raised from external investors, including so-called business angels and venture capitalists. Investors will be looking for an annual dividend, which often can be quite small, and a good return when they sell their shares. Externally invested equity is best suited, therefore, for businesses that expect to grow quickly, though normally the person starting the business will be expected to contribute some equity in order to lever additional funding from elsewhere. As with debt financing, additional equity often comes from non-professional investors such as friends, relatives, employees, customers, or industry colleagues. However, the most common source of equity funding comes from venture capitalists, principally under the small and medium industry equity investment scheme. These are institutional risk takers, but could be groups of wealthy individuals or government assisted sources. Venture capitalists are often seen as deep-pocketed institutions looking for startups or grown phase business in which to invest their money. However, they are most often very selective in their choice of investments preferring existing companies with the potential to become major players and return higher than average profits to their shareholders. They also have different approaches to management of the business in which they invest. Venture capitalists generally prefer to influence a business passively, but will react when performance falls below expectations. In such cases, they may insist on changes in the management or strategy, thus relinquishing some of the decision making and some of the potentials for profit. Are the main disadvantages. Debt financing. Debt finance is simply money that is borrowed from a financial institution or from your suppliers. Loans are repaid over a period of time at either fixed or variable rates of interest. The lender may require security against a business or personal asset. Terms can vary in length and will usually be determined by the asset that is being financed. The interest rate will reflect the lender's perception of the risk in providing the loan. There are many sources for debt financing, including commercial and development banks, savings and loans, finance companies, and other non-bank financial institutions. Most of these sources will only provide short-term financing, as banks generally are reluctant to offer long-term loans to small firms. This is because of the associated costs and logistic challenges. Moreover, in addition to equity contributions, lenders commonly require the borrower's personal guarantees in case of default. This is to ensure that the borrower has a sufficient personal interest at stake to give required attention to the business. For most small business borrowers, this is a major challenge. Thus, if you need a relatively small amount, or if you have no savings and a limited track record, you are advised to start with the microfinance banks. If you need a large sum, you will need to try the banks, but try more than one to get the best deal. Be sure that you understand the terms that the bank may use. Sources of debt financing. As indicated earlier, debt or loan finance can be provided in different ways. These include overdraft term loans, creditor finance, debtor finance, and grants. Overdraft. This is money that a business can borrow from a bank up to an agreed limit. It provides a business with short-term finance effectively by running a negative balance on the bank's current account. This is a particular good way of funding short-term requirements, such as providing working capital during the course of each month. The borrower will repay on interest, which is usually a small amount of the borrowed sum, and sometimes a periodic payment, that is, quarterly or annual arrangement fee. It is therefore expensive, but because you are only borrowing the exact amount required, the total cost may be less than having a term loan. Term loans. These are funds borrowed for a fixed term. Usually, such loans are repayable in equal installments over the term of the loan, although sometimes can be repaid in a lump sum at the end of the term. Most businesses require capital assets that have a useful life of several years. These include equipment, machinery, vehicles, and buildings. Lenders are attracted to this type of finance because they can use the asset as security against loan. They will usually require an initial deposit of a proportion of the purchase price, depending upon the asset. its expected lifespan, and the repayment period. Medium-term loans, that is 3 to 7 years, are usual for equipment and machinery, while long-term loans, that is 10 to 20 years, are used for the purchase of land or building. Creditor finance. This is an excellent way of borrowing money, effectively at no cost. Typically, suppliers may give 30 to 60 days credit for their goods or services before payment is due. If you can sell your products or services and get paid before paying your creditors, then it will generate cash into the business. Your business may have to establish a trading record before credit is given, and it can be withdrawn at any time. Some businesses, such as retailers and many other businesses, receive payment from their customers before they have to pay their suppliers. So these businesses can fund at least part of their working capital from using the credit provided by trade creditors, and once established may find that no other finance is required. Debt finance. Instead of waiting for your own customer to pay your invoice within a 30 or 60-day period, a business may use the services of a third-party invoice discounting or factoring firm. This is particularly useful for businesses that are growing rapidly and are providing credit accounts to their customers. The factor or invoice discounter will provide a business with an advance on the value of each invoice as soon as the invoice is processed. Interest is charged on the balance drawn plus a service charge. In the case of factoring, the customer then pays the factor directly. If you use invoice discounting, it is possible to retain control of collection so that your customer do not know that you are using an invoice discounter. Unless you go for non-recourse factoring, the money from the factor is simply a loan you will need to repay if any of your customer defaults. Factoring can be an expensive way of speeding up cash flow, but it may reduce administrative costs since the factor normally takes on the role of the invoice clerk. Grants. You need to explore the different grants that may be available to your business and examine whether you meet the criteria. For example, grants may be available to firms setting up in rural areas. Considering the requirement that you need to satisfy, you need to think very carefully about whether it is worth applying for the grant in the first place. Grants are usually one-off payment, providing a percentage of the cost towards a specific purpose, usually for capital expenditure, but sometimes for a specific activity such as taking part in an exhibition or trade fair. Amounts vary depending on the scheme. A grant may be available from the government or non-governmental organizations. Capital assets finance. Financing capital asset can often be done through off-balance sheet finance, which include leasing, lease purchase, and hire purchase. Financial leasing. This is a way of financing the use of an asset rather than having ownership of the asset. The equipment remains the property of the leasing company. The business has the legal right to use the equipment for the period of the lease, provided that the lease payments are up to date. Lease purchase arrangement. Under this arrangement, the business has an option to purchase the equipment at the end of the lease period. Hire purchase. This is a way for a business to purchase ownership of plant and machinery from a supplier. The business pays a regular installment to a third party, normally a finance house. The finance house will own the equipment throughout the period of the arrangement until the business finally owns the equipment after the last installment has been paid. Development finance institutions. Specialized banks or development finance institutions have been established to contribute to the development of specific sectors of the economy. They consist of the Nigerian Industrial Development Bank (NIDB), Nigerian Bank for Commerce and Industry (NBCI), Nigerian Agricultural and Cooperative Bank (NACB), and Urban Development Bank (UDB). Nigerian Industrial Development Bank. The Nigerian Industrial Development Bank was established in 1964 following the restructuring of the Investment Company of Nigeria (ICON). Specifically, NIDB was set up to provide credit and other financing to industries, particularly medium and large-scale enterprises. Recently, some small-scale enterprises have also benefited from its financing. The NIDB sources funds from banks, the central bank, the federal government, and International Finance Corporation. Nigerian Bank for Commerce and Industry. The federal government established the Nigerian Bank for Commerce and Industry in 1973 in the wake of its indigenization of the economy policy in 1972. The NBCI was set up to develop national enterprise in small and medium scale. Sources of funds for NBCI are subvention from the federal government and CBN through penalties imposed on commercial and merchant banks for credit shortfalls on loans to small and medium scale enterprises. The bank also engages in share underwriting, project identification, and feasibility studies. Nigerian Agricultural and Cooperative Bank (NACB). The Nigerian Agricultural and Cooperative Bank was established mainly to finance agricultural development projects and allied industries. In its operations, the bank usually interacts with state ministries of agriculture. It also sources its funds from government subventions, credit shortfalls on agricultural loans by commercial and merchant banks through the central bank, and loans from international finance institutions such as the International Bank for Reconstruction and Development, the African Development Bank (ADB), the European Investment Bank (EIB), and the International Fund for Agricultural Development (IFAD). Urban Development Bank. Nigerian cities experience problems of inadequate housing, transportation, electricity, and water supply. In order to create a greater capacity for dealing with these problems, the federal government established the Urban Development Bank in 1992. The bank is operated strictly as an independent profit-making institution and provide financial resources to both the public and private sectors for the development of urban dwelling, mass transportation, and public utility. The UDB may, with the approval of the Ministry of Finance, raise funds in foreign currency. Like other specialized banks, the UDB is exempted from some of the provisions of the Bank and Other Financial Institution Decree of 1991. Summary. In this study session, you learn that the sources of finance for new business progresses from own savings, family, and friends to issue of shares as the business grows. The two main types of financing are equity and debt financing. When looking for money, you must consider your company's debt to equity ratio, which determines the leverage level and level of gearing. We also discuss debt finance, which is simply money that is borrowed from a financial institution or from other sources. The sources of debt finance include overdrafts, term loans, credit finance, debtor finance, and grants. The additional sources of financing capital assets include leasing, lease purchase, and hire purchase agreement. Specialized banks or development finance institutions that have been established to contribute to the development of specific sectors of the economy include Nigerian Industrial Development Bank (NIDB), Nigerian Bank for Commerce and Industry (NBCI), Nigerian Agricultural and Cooperative Bank (NACB), and Urban Development Bank. This is the end of study session 3. Thanks for listening.